On Sunday, January 4th, 2026, former Federal Reserve Chair and Treasury Secretary Janet Yellen stood in front of a panel at the American Economic Association and said something that made every economist in the room go quiet. She said, and I quote, "The preconditions for fiscal dominance are clearly strengthening." If you're not an economist, that phrase probably means nothing to you. But to people who study money and government debt, those words are terrifying. Fiscal dominance is the economic version of crossing the point of no return. It's the moment when a country's debt becomes so large that the central bank can no longer fight inflation without risking a government default. According to a Fortune magazine article published the next day on January 5th, the United States is now staring down a 120% debt-to-GDP ratio with $38 trillion national debt, and Yellen warned that debt is on a steep upward trajectory toward 150% of GDP over the next 3 decades. To understand why this matters, Fortune used an analogy that makes it crystal clear. Imagine the U.S. economy is a car. The Treasury Department is the driver, deciding when and how much to spend. The Federal Reserve is the brake, raising interest rates to slow down inflation when the Treasury spends too much. For most of American history, the system worked fine. The Fed could hit the brakes whenever inflation started rising, and the economy would slow down. But now, the car is towing a $38 trillion trailer. That's the national debt. The weight is so massive that if the Federal Reserve tries to hit the brakes too hard by raising interest rates, the brake pads will explode from the pressure. In other words, if the Fed raises rates to fight inflation, the government's interest payments become so expensive that it risks default. The brakes don't work anymore. Heather Long, the chief economist for Navy Federal Credit Union, told Fortune something even more direct. She said, "The bond market is the new king in the United States. Not the Federal Reserve, not Congress, the bond market." For most nations, Long explained, crossing the 120% debt-to-GDP threshold is a game changer that gives bond investors significant influence over the rest of the economy. And the United States just crossed that line. Eric Leeper, a professor at the University of Virginia and former Federal Reserve economist, went even further. He told Fortune that for most of American history, the U.S. operated under what he calls the Hamilton norm, the expectation that any debt issued today would be fully financed by future tax surpluses. That norm, Leeper said, died in 2020. And now he said, if faith in America's ability to manage its debt starts to get shattered, then we're really in deep doo-doo. Those were his exact words. Deep doo-doo. So what is fiscal dominance? Why did Janet Yellen wait until January 2026 to finally say those words out loud? And what happens next now that we've crossed the line? Let's put some actual numbers on the table so you understand how big this problem is. According to the Congressional Budget Office's monthly budget review published in January 2026, the United States government spent $276 billion on interest payments in just the first 3 months of fiscal year 2026. That's October, November, and December of 2025. $276 billion in 3 months. That's $31 billion, more than the same 3 months a year earlier, a 13% increase year over year. According to Fortune magazine's reporting from January 12th, that works out to more than $11 billion per week in interest payments. Think about that for a second. $11 billion every single week. Not going to roads, not going to schools, not going to healthcare, not going to defense. Just interest on money we borrowed in the past. The Peterson Foundation, which tracks federal debt data obsessively, pointed out in their December 18th report that interest payments through November 2025 were 11.9% higher than the previous year. And here's the kicker. The Congressional Budget Office reported that interest is now the second largest spending category in the entire federal budget. Only Social Security is bigger. Interest payments have already surpassed Medicare, Medicaid, and national defense. In fact, according to Epic for America's Analysis, published January 15th, the interest paid in just the first 3 months of fiscal year 2026, that $276 billion is more than the entire year's worth of interest payments in fiscal year 2017. 9 years ago, we paid $263 billion for the whole year. Now we're paying that much in 90 days. For the full fiscal year 2025, which ended in September, the government spent $1.22 trillion on interest alone, according to Treasury Department data. That's trillion with a T, 1.22 trillion, just to service the debt. And it's getting worse. The Peterson Foundation published an analysis of the Treasury's quarterly refunding process in December and found that the government plans to borrow $158 billion more in the first half of fiscal year 2026 compared to the same period last year. More borrowing means more debt. More debt means more interest. The cycle accelerates. According to the Peterson Foundation's December report, interest costs now represent 3.2% of GDP in 2026. That's the highest it's been since 1991. And the Congressional Budget Office projects it will climb to 4.1% of GDP by 2035. As a share of federal revenues, interest payments hit 18.4% by the end of 2025. The Peterson Foundation projects that number will reach 22.2% by 2035. That means more than $1 in every $5 the government collects in taxes will go straight to paying interest, not building anything, not funding anything, just paying the cost of past borrowing. The current national debt stands at $38.4 trillion as of January 2026, according to Treasury data. And unlike previous eras when debt grew during wars or economic crises and then shrank afterward, this debt just keeps climbing. There's no plan to pay it down. There's no surplus on the horizon. There's just more borrowing, more debt, and more interest, compounding year after year. To understand why fiscal dominance matters in 2026, you have to understand how the Federal Reserve used to fight inflation back when it actually had the power to do it. The textbook example is Paul Volcker. In August 1979, President Jimmy Carter appointed Volcker as Federal Reserve Chairman. At the time, the United States was stuck in what economists called stagflation, high inflation, combined with slow economic growth and high unemployment. It was the worst of both worlds. Inflation had been running hot throughout the 1970s, and by March 1980, it peaked at 14.8%. Some sources put the peak slightly later at 13.5% in 1981, but either way, inflation was in the double digits and nobody could stop it. The previous Fed chairman had tried raising rates a little, then backing down when the economy weakened. People expected this stop-and-go pattern, so inflation expectations stayed high. Volcker decided to break that pattern. When he took over in 1979, the federal funds rate averaged 11.2%. Volcker started raising it, and he didn't stop. By June 1981, the federal funds rate hit 20%. 20%. The prime rate, the rate banks charge their best customers, hit 21.5%. To put that in perspective, if you wanted to buy a house in 1981, your mortgage rate would have been over 18%. The economy collapsed. The United States went through 2 recessions between 1980 and 1982. Unemployment soared above 10%, peaking at 10.8% in late 1982. The construction industry was devastated. Manufacturing jobs disappeared. Farmers couldn't service their loans. It was brutal. Volcker faced the strongest political attacks in Federal Reserve history. During a 1981 congressional hearing, Republican Congressman George Hansen shouted, "We are destroying the small businessman. We are destroying middle America. We are destroying the American dream." Democrat Henry Gonzalez from Texas threatened to introduce a bill to impeach Volcker. Protesters gathered outside the Fed. Home builders sent Volcker 2x4s in the mail to symbolize the collapse of their industry. But Volcker didn't back down. He told Congress, "We have set our course to restrain growth in money and credit, and we're not changing it." And it worked. By October 1982, inflation had fallen to 5%. By 1983, it dropped to 3.2%. Unemployment came back down to 8% by the end of 1983, and the economy entered a long period of growth and stability. Economists call this the incredible Volcker disinflation, and it's held up as proof that central banks can control inflation if they're willing to accept the short-term pain. But here's the part that almost nobody mentions. According to the Chicago Booth Review, when Paul Volcker started raising rates in 1980, U.S. federal debt held by the public was about 25% of GDP. 25%. That's it. The government's interest costs were manageable. When Volcker raised rates 1 percentage point, it raised interest costs on the debt by 1% of 25% of GDP. That's a tiny number. The government could absorb it. There was no fiscal crisis, no threat of default, no bond market revolt. Volcker could raise rates as high as he needed to crush inflation, and the government's budget could handle it. The brake pedal worked because the car wasn't towing a $38 trillion trailer. So now we get to the core problem. In 1980, when Paul Volcker raised interest rates to 20%, the U.S. debt held by the public was 25% of GDP. Today, in 2026, it's 120%. That's almost 5 times higher. Here's why that matters. According to data from Financial Design Studio published in May 2024, the average interest rate on all outstanding government bonds was 1.6% at the end of 2021. By March 2024, that rate had doubled to 3.22%. By 2025, Brookings Institution and CBO data show it hit 3.3%. It doubled in less than 4 years. When Volcker raised rates in 1980, the math was manageable. If he pushed the federal funds rate up by 1 percentage point, and that eventually raised the average interest rate on the debt by 1 point. The government's interest costs went up by 1% of 25% of GDP. That's a tiny number, about 0.25% of GDP. The government could absorb that. The budget didn't explode. Volcker had room to operate. But in 2026, the same 1 percentage point increase in the average interest rate on debt raises the government's costs by 1% of 120% of GDP. That's 1.2% of GDP, almost 5 times worse. And here's the vicious cycle that creates fiscal dominance. When the Federal Reserve raises interest rates to fight inflation, it makes borrowing more expensive for everyone, including the government. The government is already running a massive deficit, about $2 trillion a year in 2025, according to the Foreign Affairs Forum's January 2026 report. That's 6% of GDP. Janet Yellen herself said in her Brookings remarks published just last week that, quote, that level has never before been realized, except during wars and recessions. So the government is already borrowing $2 trillion a year. When the Fed raises rates, the interest on that debt goes up. Higher interest costs mean the deficit gets even bigger. A bigger deficit means the government has to borrow even more money. More borrowing means more debt. More debt means even higher interest costs next year. It's a feedback loop. And here's the kicker. When the government pays interest to bondholders, then that money goes into the economy. If you're a retiree holding Treasury bonds, or if you're a pension fund, or if you're China or Japan holding $1 trillion in treasuries, you get that interest payment. And what do you do with it? You spend it or invest it. That money circulates through the economy, adding to demand. Higher demand can push prices up, which is inflation. So by raising rates to fight inflation, the Fed is actually pumping money into the economy through higher interest payments, which can fuel more inflation. The brakes create more speed. This is what economists mean when they talk about fiscal dominance. The fiscal situation, the debt and deficits, has gotten so large that it constrains what the central bank can do. The Federal Reserve can't just pull a Paul Volcker anymore. If the Fed tried to raise rates to 20% today, the interest on 120% of GDP would explode. The deficit would spiral out of control. The government might not be able to sell its bonds. We'd be looking at a sovereign debt crisis. According to the Foreign Affairs Forum's analysis from January 5, 2026, federal debt held by the public stood at approximately $5 trillion in 2006, or about 35% of GDP. By the end of fiscal 2025, that figure had swollen to more than $30 trillion, or nearly 100% of GDP. That's a 9-fold expansion in 19 years. And it happened through a combination of the 2008 financial crisis stimulus, nearly $6 trillion in COVID spending between 2020 and 2022, repeated tax cuts, and most recently, the One Big Beautiful Bill Act, signed into law in 2025, which the CBO estimates will increase deficits by $3.3 trillion over the next decade. So here's where it gets really interesting. Remember when Heather Long, the chief economist at Navy Federal Credit Union, told Fortune that the bond market is the new king in the United States? This is what she was talking about. In September 2024, the Federal Reserve started cutting interest rates. They cut the federal funds rate from a range of 5.25 to 5.5% down to 4.25 to 4.5% by the end of the year. That's a 100 basis point reduction, a full percentage point. Normally, when the Fed cuts rates, long-term bond yields fall too. Lower rates mean cheaper borrowing, which slows the economy and reduces inflation, so investors expect lower yields in the future. Bond prices go up, yields come down. That's how it's supposed to work, but that's not what happened in late 2024. According to data from Baird Trust, published in January 2025, the 10-year Treasury yield started the year at 3.88%. By the end of 2024, it had risen to 4.57%. That's 70 basis points higher. The Fed was cutting rates, and long-term yields were going up. By mid-September 2024, right before the Fed's first rate cut, the 10-year yield had fallen to 3.6%. Investors thought the Fed was about to ease monetary policy, so yields dropped. Then the Fed cut rates in September, and what happened? The 10-year yield surged. By January 15, 2025, it hit 4.8% according to Morningstar's analysis. That's 100 basis points higher than the September low. The Fed cut rates by 100 basis points, and long-term yields rose by 100 basis points. JP Morgan Private Bank published an analysis in January 2025, pointing out just how unusual this is. They looked at the previous 7 Federal Reserve cutting cycles going back to the 1980s. In every single one of those cycles, 100% of the time, the 10-year Treasury yield was lower 100 days after the first rate cut. Not this time. This time, yields went up. Ed Yardeni, president of Yardeni Research, said it bluntly in a note to clients published by CNN Business on December 11th. He said, bond investors aren't following the Fed's easing script. They remain concerned about large U.S. federal budget deficits and mounting U.S. debt. They can see that inflation remains above the Fed's 2% target. What Yardeni is describing is the bond market revolt. The bond market is basically saying, we don't care what the Fed is doing with short-term rates. We're worried about inflation staying higher for longer. We're worried about the government borrowing trillions of dollars every year. And we're not going to lend money to the government at 3.6% anymore. If you want us to buy your bonds, you're going to have to pay us more. A lot more. According to Morningstar's data from February 2025, core personal consumption expenditures inflation, the Fed's preferred measure, was running at 2.5% in November 2024. That's still above the Fed's 2% target, and it had been ticking up from 2.3% in August. Markets started pricing in the possibility that inflation might not come down as quickly as the Fed hoped, or that it might even reaccelerate. On top of that, according to analysis from Damon Markets, the U.S. federal deficit is projected to remain at 5 to 6% of GDP. That's a peacetime record. The government has to borrow trillions to cover that deficit, which means issuing more bonds. More supply of bonds pushes yields up. J.P. Morgan's analysis from January 20 to 25 shows that the compensation investors demand to hold long-term government debt. What they call the discount rose from about 85 basis points in October 2024 to 95 basis points by January 2025. That's a sign that investors are pricing in more risk. They're demanding higher yields to compensate for the uncertainty around inflation, deficits, and debt. This isn't the first time a government has found itself trapped between debt and inflation. History is full of empires that tried to solve their fiscal problems by debasing the currency, and it never ends well. The most famous example is ancient Rome. Under Augustus, who ruled from 27 BC to 14 AD, the Roman denarius was a high-quality silver coin. It weighed 3.9 grams and was 95 to 98% pure silver. A Roman legionary earned 225 denarii per year. One denarius could buy 6 liters of wheat. It was stable money that people trusted. The system worked for decades. But then the costs of running the empire started to outpace revenues. Wars drained the treasury. Emperors needed to pay soldiers to keep them loyal. And instead of raising taxes or cutting spending, they did what seemed easier at the time. They started reducing the silver content of the denarius. Emperor Nero, who ruled from 54 to 68 AD, was the first to make a significant debasement. He reduced the silver content to 90% and cut the weight to 3.41 grams. It was a 14% reduction. Most people didn't notice at first. The coins looked the same, but the precedent was set. Under Emperor Trajan, around 107 AD, the silver content dropped to 80%. Under Marcus Aurelius, who ruled from 161 to 180, it fell to 70%. By the time Septimius Severus and his son Caracalla were in power from 193 to 217, the denarius was down to 40 to 50% silver. Caracalla went even further. In 215 AD, he introduced a new coin called the Antoninianus. The government said it was worth 2 denarii, but it actually contained only 1.5 times the silver of a single denarius. Caracalla pocketed the difference to pay his troops. This was outright monetary fraud, and it accelerated inflation. Prices started rising to compensate for the devalued currency. By the reign of Claudius II in 269 AD, the Antoninianus had been debased down to just 2% silver. 2%. It was basically a bronze coin with a thin silver wash. Emperor Aurelian, who ruled from 270 to 275, tried to reform the coinage. His new Antoninianus contained just 5% silver, and soon after, it was minted entirely in bronze. By the 260s AD, the ratio between gold and the debased denarius had collapsed from 25 to 1 under Augustus to 1,000 to 1. Gold held its value. The silver coinage was worthless. According to the World History Encyclopedia, prices rose by 1,000% in many parts of the empire during the 3rd century crisis. Trade networks broke down because merchants didn't trust the currency. People hoarded the old silver coins and tried to trade in gold or barter. The economy fragmented into local subsistence systems. Cities that had thrived for centuries were abandoned. The empire entered what historians call the crisis of the 3rd century, from 235 to 284 AD. During that 50-year period, there were at least 26 different claimants to the title of emperor, most of them generals fighting each other in civil wars. Each new ruler needed money immediately to pay the army, so they debased the currency even more. It was a death spiral. Emperor Constantine tried to restore trust in the currency in 312 AD by introducing a new coin called the solidus, made of pure gold and weighing 4.5 grams. It worked for a while in the Eastern Roman Empire, which eventually became the Byzantine Empire and lasted another 1,000 years. But the Western Roman Empire never recovered. The economy was too damaged. The currency was too debased. Trust was gone. In 476 AD, the Western Roman Empire officially fell. So what actually happens next? The Congressional Budget Office published its long-term budget outlook in March 2025, and the numbers are stark. Right now, in fiscal year 2025, federal debt held by the public is at 100% of GDP. We're already at the line. By 2029, just 3 years from now, the CBO project's debt will hit 107% of GDP. That is the moment when we officially surpass the World War II record of 106% set in 1946. For the first time in American history, peacetime debt will be higher than wartime debt. By 2035, debt rises to 118% of GDP, according to the CBO's January 2025 baseline. Interest payments hit $1.8 trillion per year, which is 4.1% of GDP, according to the Committee for a Responsible Federal Budget. That's more than we'll spend on national defense. It's more than we'll spend on all non-defense discretionary programs combined. By 2055, assuming current laws don't change, debt reaches 156% of GDP. Interest costs hit 5.4% of GDP, consuming 28% of all federal tax revenue, according to the CBO. Just to put that in perspective, over the next 30 years from 2025 to 2055, the U.S. government will spend $76 trillion on interest payments alone, according to analysis by the Committee for a Responsible Federal Budget and the Peterson Foundation. $76 trillion. That's more than the entire current national debt twice over, just in interest. And those are the optimistic projections. The CBO also ran alternative scenarios. If productivity growth is lower than expected, debt could hit 203% of GDP by 2055. If interest rates stay higher than projected, debt could exceed 204%. If the government's borrowing crowds out private investment more than the CBO assumes, debt could exceed 250% of GDP. If the Tax Cuts and Jobs Act gets extended permanently instead of expiring, the Committee for a Responsible Federal Budget estimates deficits could balloon to 11% of GDP by 2055, and interest costs could approach 8% of GDP. And here's the kicker that nobody wants to talk about. The CBO projects that the Social Security, Old Age, and Survivors Insurance Trust Fund will be depleted in 2033. That's just 8 years from now. When that happens, under current law, benefits automatically get cut by 24%. $1 in every $4 of Social Security benefits disappears overnight unless Congress acts. The Committee for a Responsible Federal Budget points out that the average interest rate on federal debt is projected to exceed the economic growth rate by 2045. That's when what economists call the debt spiral begins. When the interest rate is higher than the growth rate, debt starts growing faster than the economy. At that point, you can't grow your way out anymore. The math doesn't work. You're trapped. This brings us back to Eric Leeper's warning from the Fortune article on January 5th. He said, "We're really in deep doo-doo if faith starts to get shattered." Faith is the key word. Right now, investors still believe the U.S. government will pay its debts. They still believe the dollar is safe. They still believe American Treasury bonds are the safest asset in the world. But belief can change, and when it changes fast. If bond markets lose confidence, yields spike. The government can't sell its bonds. Interest costs explode. The deficit spirals. You get a sovereign debt crisis. It's happened to other countries: Greece, Argentina, Turkey, Lebanon. It can happen here. So let's bring this all together. On Sunday, January 4th, 2026, Janet Yellen stood in front of a panel at the American Economic Association and said the words that should terrify everyone. The preconditions for fiscal dominance are clearly strengthening. What she meant is this: the United States has crossed into territory where the Federal Reserve can no longer control inflation without risking a government debt crisis. The debt is too big. 120% of GDP compared to Paul Volcker's 25% in 1980. The interest costs are too high, $1 trillion a year and climbing to $1.8 trillion by 2035. The deficits are too large, $2 trillion a year in peacetime, 6% of GDP, a level Janet Yellen herself said has never before been realized except during wars and recessions. When the Fed tries to raise rates to fight inflation, it makes the debt problem worse. Higher rates mean higher interest payments. Higher interest payments mean bigger deficits. Bigger deficits mean more borrowing. More borrowing means more debt. The feedback loop accelerates. The bond market knows this. That's why in late 2024, when the Fed cut rates by 100 basis points, the 10-year Treasury yield went up by 100 basis points. Bond investors aren't following the Fed's easing script anymore. They're demanding higher yields to compensate for inflation risk and fiscal risk. The bond market is now king, not the Federal Reserve. History tells us how this ends. Ancient Rome debased the denarius from 95% silver under Augustus to 2% silver under Claudius II. It took 300 years, but the currency collapsed, trade networks broke down, and the Western Roman Empire fell in 476 AD. The United States isn't going to debase physical coins, but inflating away debt through money printing has the same effect. Savers get destroyed. Bondholders lose purchasing power. Trust in the currency erodes. And once trust is gone, it's almost impossible to get back. Eric Leeper, the University of Virginia economist and former Fed official, put it bluntly. He said, "We're really in deep doo-doo if faith starts to get shattered. Faith is all that's holding this together. Faith that the U.S. government will pay its debts. Faith that the dollar is safe. Faith that American Treasury bonds are the safest asset in the world. But faith can break. And when it does, it breaks fast. We've seen it in Greece, Argentina, Turkey, Lebanon. It can happen here. The Congressional Budget Office projects debt will hit 107% of GDP by 2029, surpassing the World War II record. 118% by 2035. 156% by 2055. Over the next 30 years, the government will spend $76 trillion just on interest payments, not building roads, not funding schools, not paying for defense, just servicing past debt. In my last video, I explained how we got here. I broke down the real story of how America escaped its debt after World War II and why the same methods won't work today. If you haven't watched that yet, I'll link it in the description. It's called Federal Debt Eclipses GDP in 2026, the first time since WWII. That video shows you the history. This video shows you the trap we're in right now. The preconditions for fiscal dominance are strengthening. The bond market is revolting. The Fed is trapped. And the clock is ticking toward 2029 when we surpass the World War II debt record in peacetime for the first time in American history. If you want to understand where this is heading, subscribe to this channel. Because this story is just beginning, drop a comment below. Do you think the bond market will lose faith in U.S. debt, or can we avoid the trap? Hit subscribe, and I'll see you in the next one.